We think it's the demise of the central banks. After all, they're not permanent institutions. The Fed's about 100 years old. It's a baby. Especially over the last 50 years, it's created nothing but boom-bust cycles. The problem now is the bust that they're creating is a bubble that is the biggest stock market bubble in U.S. market history. When it comes unwound, and they help provoke it, stick a pin in it, we call it stick it a saber in it, and then we can report. And it starts to come unwind, and they got a problem. Because that won't just be a market downturn. That will be a public sentiment downturn. It'll be a corporate policy downturn. Corporate spending will change. A lot of things will change. And all their economic numbers that they like to point to as being strong will suddenly go reverse. And they'll be sitting there raising rates in that environment. They'll lose all credibility.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us once again today.
Hi Elijah, good to be back.
Well, it's great to have you. You're one of our viewers' favorite guests, and we wanted to discuss the precious metal markets first and foremost. In your weekly report, you were mentioning how really in the last 4 weeks, ever since that rally, we've seen that pullback, and then for the last 4 weeks, we've seen consolidation in gold, and it's been very oddly quiet and even possibly suppressed, you were mentioning. So can you expand on this?
Well, we're not big on the conspiracy theory stuff about the controlling efforts to control gold, but we know throughout history there have been times that governments around the world, the U.S., and like the IMF, for example, dumped tons of gold back in the late 1970s into that 1980 bull market. And initially in the bull market, when they hit it with 50 tons of gold, 200, whatever, and it would sell it at prices lower than the market even, it would knock gold down a bit. But after a while, those auctions didn't have any effect at all. In fact, the market just went right through them. So there's a point at which even if a market is being trying to be capped by somebody or some entity, for whatever reason, usually government policy, it doesn't work in the long run if reality says no. Reality will overcome their selling pressures. Central banks are not omnipotent. We know that. At least we should know that. In fact, they create the problems that they later try to cure. So anyway, but the action in gold, we ran up to, on March the 8th, there was the high close in gold. It got up above the summer high of 2020, which was $2,070. Okay, we got to 2,078 on March the 8th, closed slightly off the high, and then we dropped hard for about 5 days. Traded under 1,900, so meaning you had a $170, $80 drop real quick, and then it stopped. Okay. Now, that was coincident, by the way, with an inverse situation in the S&P 500. It made its low close in March on March the 8th. So we've been making the point to especially gold investors and gold mining investors who tend to be nervous about a weak stock market, that the weak stock market is, in fact, positive for gold now. In fact, you overlay the chart of gold and the S&P, and they're exact opposites. So as the S&P rallied up off that March low, gold sold off its March high. But then gold went into a tight-fisted congestion zone with a couple ticks below 1,900, never closed below it, and a range in price for 4 weeks between about 1,950, 60 on the upside and around 1,900 on the downside. Generally, most of the highs were around 1940. So it was extremely narrow, quiet little range. During that same time, the S&P was cresting, by the way. Now, the S&P is rolling back over now, if you'll notice. So gold is shot back up today, got up to 1970, I believe. I think it's mid-1950s right now. But the behavior of that 4 weeks was highly unusual. We went from extreme volatility to extreme quiet, like a light switch had been hit. Well, we pointed out to our subscribers in our weekend reports. We put out a report about every day, but the weekend report's generally long. That yes, it might have been capped by somebody or some institution trying to keep gold suppressed. But if you look at the lows, somebody was bidding because the lows were equally tight and equally well bid for. So it was an arm wrestling match. So, we can look at the attempt to cap it, but there was also a floor under it. And I'll bet that wasn't government buying it. I bet it was investors. Now, another thing happened in the last 4 weeks, which is quite interesting. The gold miners. During a corrective process like we've had from summer of 2070 high through late last year, the miners suffered more on the downside than did gold. In fact, gold made its low for the entire correction in March of 2021, never took it out again, whereas the miners kept bleeding down a little bit, while gold was attempting to firm. We noticed about 3 or 4 weeks ago that the relative performance had shifted. We ran our spread charts between, let's say, GDX and gold, or the XAU index and gold, such that it said, favor the miners now. Well, sure enough, if you look at a gold chart for the last 5 weeks, go back to that March high 6 weeks ago, you dropped down and went into a range, and you didn't go back to that high. The gold miners went back to that high. In fact, they made a higher high today. So while the gold miners pull back a minor bit from that early March high, they've taken it out since then. So the miners are definitely stronger than gold, which indicates to us not just that there's individual buyers of the miners, but that there's asset managers buying gold miners, because generally large fund managers won't go in and buy gold futures or bullion. They'll buy them companies, and they'll tend to defer to the larger, what you might call the blue chip companies like Newmont, for example. And so that's why I think you've seen this shift favoring the miners. It's a good sign for the overall gold, silver, and mining market.
I think that makes sense as well, because, you mentioned that if we're seeing bullish action in the miners, then that might signal a future run in the whole sector in precious metals. That kind of makes sense, because it seems like people are anticipating higher gold prices, and therefore that's good for the miners. So are they kind of pricing that in already? Is that kind of what you're seeing?
I think that's what's going on. I think they're gaining back some of the lost performance that they had for the last year and a half. They gained it back very quickly, by the way. And I think that, for instance, look at the XAU index, which is the oldest gold mining and silver mining index that's been around. It's not an ETF, it's an index. It's been around since the 1970s. It's back to the August highs of 2020. It's just sitting there, right at those highs. It didn't back off recently. It's glued to those highs. In fact, it may have already made a new high. So the miners are definitely acting better, not just over the last 4 or 5 weeks, but when you look at the last couple of years, they're back at the highs. Gold is still now 100 or so off that high because of the recent drop. But the tone in gold looks good. Silver, we still favor silver over gold on a spread basis, meaning we think it will, on a percentage basis, in the bull run to come, which is to say the remainder of the bull run we've already been in, will outperform gold on a percentage basis. We also think the miners will outperform gold on a percentage basis. So that's where we would put our emphasis.
What are some of the price points in silver that you're looking for silver to take out? Silver
turned up via its what we call quarterly momentum, meaning we measure the price of silver in relation to its 3-quarter moving average. On a momentum chart, it broke out 5 or 6 weeks ago when it came up through the low 24s. Okay, its initial shot took it over 27, and it pulled back down into the low 24s again and sat on that support, and now we're back in the low 25s. We've got some numbers above that are on a larger time scale. In fact, it's a 200-week momentum chart. Okay, it's like a 4-year average. It has a structure such that if you get back up anywhere in the high 26s again, it says, okay, I'm engaging as well. It looks very ripe to do so. I don't think resistance, which is pretty obvious on a price chart. When you look at a price chart, you'll see there's a zone from $28 to $30 where the high weekly closes were, either side of 28, and a couple high trades. This is back in 2020 and early 21. I don't think it's going to be an effort to get through that stuff. The issue is getting up to it. And I think once you get up to it, you're going to zap through it quickly. And I think the tone in silver will change dramatically. And so right now, if I put a new number on silver that would say, okay, we're not only positive now, basis quarterly momentum, but we're going to engage the 4-year average structure, which is already positive. It's a secondary buy structure. It's hard to explain. Anyway, you get in the upper 26s again. You don't even have to get back to that high we made in early March. You get upper 26s, underside of 27, you should be back to the highs very rapidly, back to that $30 range. And that should not be resistance. And I think once you clear that on the price chart basis, that's when you're going to have a lot of people who are on the sidelines say, oh, I better be in this. Because it's bleeding obvious when you look at the price chart. We go through that 30 level, it's a launch. But our numbers just below 27 right now should really engage it.
And will that need to be like a weekly close?
No, just touch it. Just get up there. Just trade up there. So that's one thing we're looking at. We also look at everything, and we look at any numbers we might have on the gold miners and so forth. But they're pretty much fully engaged now. What they did over the last 5-6 weeks in the gold miners says we're alive. We've come out of the process that we were in for the last year and a half. We're now back into the major primary trend. And I think it's very interesting that it's going on while the stock market's starting to roll over again. People need to pay attention to that.
And mentioning the stock market, it seems like what we've seen is since the beginning of the year, that fall in the stock market and then bounce. But you're really seeing this as kind of a dead cat bounce, just a rally amid this bear market we're seeing?
The rally that began from that March 8th low, it's what we call a bear market rally, counter trend rally. In other words, we broke so much long-term momentum trend structures back in January for the NASDAQ 100 and February for the S&P 500. That the rally that came from the March low didn't negate that. It was just a counter trend rally. You don't have a trend. It's very rare to have a trend that goes from Z to A or A to Z without zigzags. Expect it. In fact, all the bear markets in U.S. stock market history have had major rallies during the bear market. The kind of rallies that turn your head and make you think, oh boy, I should have bought the dip. No. And there's other markets to watch too. And we think they're important. One of the reasons we think they're important is the real culprit under all this are the central banks. They destroy the value of their money. They've done it for decades and decades. That's their job, to falsely price certain asset categories so that people feel good. The economy does well. Every decade, M2 money supply, basically since 1959 to 2020, doubled every decade, the quantity of money in the system. Well, I mean, that has an effect on pricing, but if the pricing doesn't always flow everywhere, the river flow of liquidity is driven by asset managers and investors. They put that river flow where they want to put it. And their preference happened to be, over the last dozen years, the stock market. So the inflation, the monetary inflation that the central banks created, went into the stock markets. In fact, in the case of the BOJ, Bank of Japan, they were long ago a major buyer of their stock market. They own tons of ETFs and huge percentages of the ETFs. And the Federal Reserve started that in May and June of 2020. April and May of 2020, started buying such ETFs as high yield corporate debt ETFs. Like there's one called HYG, one called JNK. These are private company, high yield, what you call junk debt ETFs. The central bank bought them outright, put them on their balance sheet. They also bought muni bonds and muni bond ETFs. There's an ETF you can watch there called MUB. If you go back and look at a price chart of these asset categories, which move in sympathy with the stock market, by the way, except recently they've let it down. They peaked when the Fed ceased buying the high-yield corporate debt ETFs in June of 2021. That's when these ETFs peaked. They didn't fall apart, but they started to roll over. Fed wasn't buying them anymore. S&P continued up through December of 2021. So there's about a 6-month difference there where the ETFs, the high-yield corporate and the muni bonds started to roll over, and S&P crawled up a little bit more. Then the S&P broke. Now all those categories are dropping. What's the significance of that to gold? These are asset categories that the Fed deems to be important. that they don't want to see go down, especially hard. Because if these asset categories go down, then your local governments are going to have trouble financing themselves. Corporations are going to have problems with their debt. That's going to cause unemployment problems. So all the good numbers you're seeing now will go away. And these markets, the behavior of these particular markets that are in sync with the S&P will generate the sort of economic data points that the Fed can then point at and say, oops, too much tightening. So they can speak as aggressively as they want to right now, and people tend to believe it. But there's a point at which these markets will generate not just declines in the prices of those markets, but in public sentiment, in corporate policy, hiring, etc. So watch those markets, because as those events start to unfold piecemeal, what is that going to do to gold? It's going to indicate that the central banks have no choice, and I'm not talking just the Fed, I'm talking the ECB and the BOJ, have no choice but to go full throttle monetary inflation again. Otherwise, their bubbles are going to break, and they're going to end up not with a recession, but a depression. They'll probably end up with that anyway. But watch those markets, because that's the kind of stuff that will cause the Fed to do another about face. And of course, what's going to happen if the Fed changes their policy sometime 3 or 4 months from now? Suddenly no more half-point increases, but no increase this month. Surprise. It's going to signal to gold that, it is the alternative asset category that asset managers and investors are buying to protect themselves from inflation. They're divesting themselves of these other markets. And that's why it's important for gold.
No, we asked viewers to submit questions, and they're on kind of two different markets, actually. So we're going to tackle one at a time here. As we're on the topic of precious metals and what kind of markets are going to impact that, this viewer is wanting to know how much further will the U.S. dollar rise, as obviously the U.S. dollar puts pressure on precious metals.
No, it doesn't. It doesn't. The dollar index, we have abandoned analysis of the dollar index. We finally decided that fundamentally it's a joke. I'll tell you why. First off, dollar does not influence gold. It has not influenced it since 2015. If you'll go back on a chart and see where the dollar was rallying, in fact, MSA was bullish on the dollar in the 70 area, and we thought it would go to 100. It did. In 2015, it got up to 100. Okay. Actually, it got to 103 in late 2016. But if you look at it carefully over a 40-year period or 50-year period of the dollar index, it's been at about a 12% range, one of its narrowest price ranges in history of the dollar index. And right now, it is about 1 point or so above where it closed out December of 2015. December 2015, the dollar index was 98.65. Right now, it's trading in the upper 99s, okay? That's 5, 6, now going into 7 years, and it's up 1 point. And it's in an extremely unvolatile, narrow, meaningless range. Gold doubled during that time. Gold went from 1,040-something to 2,070 without the dollar doing anything but going sideways. So people who are looking at the dollar index, that is, are looking at the wrong place. Now, then let's examine what the dollar index is. It's 53.7% euro. It's, I think, 15 some odd percent yen. So it's over 70% of the dollar index is 2 money units. So if I told you I have an index of, let's say, 20 tech stocks, and of the 20 tech stocks, one of them constitutes 53% of my index, and the other one, the heaviest weighted, constitute more than 70% of my index, why even have an index? It's really not an index. It's a euro proxy, okay? Now, we can appreciate why the euro has been weak recently, especially because of, Ukraine, okay? They have economic problems due to this dislocation and energy problems, et cetera, et cetera. So the euro has been weak, and therefore it's very conspicuous the dollar has inched up a handful of points over the past 4 or 5 months. Not a big percent, yet gold has gone up during that time, okay? So don't pay too much attention to that. Also, it's a great mistake to say the dollar is strong, because if you take that view and you go into other currencies, let's say Canadian dollar or Australian dollar, and short them, based on your assumption that the dollar is strong, you got stung really bad in the last several months. 4 and 5% stung. Those currencies are in bull trends versus the dollar. So by having an index that tells you the dollar is strong or the dollar is weak, but it's based on one currency basically, that's why we've discontinued analysis of that. What we're analyzing now when we do Forex reports are the specific currencies versus the dollar, because there's a wide difference.
This same viewer is wanting to know how much further will the 10-year Treasury bond rise as this puts pressure on the stock market?
The bond market, when you're talking the 10-year or the 30-year, they have futures as well. Also, there's an ETF that's very popular, TLT, which is 20-year plus duration. So watch any of those three markets. And their price is coming down hard now. Over the last several years, up until about 4 or 5 months ago, the direction of the bond market price, meaning up in price, lower yields, was coincident with rises in gold. Meaning asset managers, when they got nervous about the stock market and wanted to park money somewhere else, would tend to park it in the T-bonds or into gold. That divorce has now occurred, where the T-bonds are no longer a, quote, alternative to the stock market. They're coincident with the stock market. In fact, their decline or rise in yields is helping spark the stock market decline. So with that in mind, treat them as in sync with the stock market now. We argue that the bond markets of Japan, Europe, and the U.S. have broken massive annual momentum trend structures, meaning they're going down. Probably for a long time and probably very deep, meaning rates are going to rise. However, when we run a more intermediate term analysis of, let's say, the 10-year bond or the 30-year or the TLT, there's some reasons to believe that soon, this month or next, you might make a low that holds for a while. And you might get a rally in there somewhere. Probably not meaningful, but some kind of holding pattern, because those markets are technically, by our metrics, reaching oversold levels, the kind of oversold levels that might generate a breathing process, a little bit of in and out instead of just straight down. So don't be surprised by that, but don't let that fool you into thinking, oh, rates are going to go lower now. No, rates are going higher, but there could be a little pause in that. So that's our view of the bond market right now.
Now, getting back to what you were talking about earlier, is you're really thinking that especially with muni bonds and high yield corporate debt and these other sectors that the Fed can't see fall in value, really the Fed is going to have to reverse and print more, because I know we just had a Fed meeting and they said, we're going to be raising rates by 0.5% next time. But so you're really still looking for that reversal.
Well, remember that they're always, quote, data sensitive, they say. Okay. Now, this is very awkward for them. And we think it's the demise of the central banks. After all, they're not permanent institutions. The Fed's about 100 years old. It's a baby. There are some people that are 100 years old. Okay. So it's especially over the last 50 years, it's created nothing but boom bust cycles. And there's some economists who are aware of that, particularly the Austrian school, where, they go through this lowering rates below reality, increasing the supply of money. It generates a stock market boom and, quote, economic boom. A lot of false indicators there. But when the stock market turns down and the economic data points turn down, what do? They have to go back to printing more, because they try to tighten here and there and they create busts. Well, the problem now is the bust that they're creating is a bubble that is the biggest stock market bubble in U.S. market history on a percentage basis and on time basis. We've gone up for a dozen years plus, and you've gone up percentages in an angle of ascent that can't be matched by any other prior bull market, including 1920s or the 2000 dot-com bubble or the 2007 peak. They're minuscule compared to what the Fed has created over the last dozen years via all kinds of tools like QEs and so forth. They now have a problem that their bubble, they won't call it their bubble, but it is. When it comes unwound and they help provoke it, stick a pen in it, we call it sticking a saber in it in the weekend report, and it starts to come unwind, and they got a problem, because that won't just be a market downturn. That will be a public sentiment downturn. It'll be a corporate policy downturn. Corporate spending will change. A lot of things will change. And all their economic numbers that they like to point to as being strong will suddenly go reverse. And they'll be sitting there raising rates in that environment. They'll lose all credibility. And if they switch back to another policy, the normal policy, to defend these assets, which won't work, never does in bear markets. They always defend bear markets, and it never stops them. They'll lose public acceptance. Academicians will say, they make no sense. They flip-flop every other year. It's chaos. They don't know what they're doing. And it wouldn't surprise us that in this crisis that we're about to move into, that the central banks come into question as to whether they continue. The political support could abandon them. And also a public acceptance of non-fiat money, gold, silver, and perhaps even some cryptos, stuff not issued by government, could ascend in popularity and acceptability.
When it comes to public acceptance of non-fiat currency, right now, the percentage of people's portfolios that is precious metals is so small right now. And it just seems like there's tremendous upside potential if we just see, it move from 0.5% to 1%, 2%, 3% of people's portfolio. That's tremendous upside for precious metals.
Absolutely. The gold and silver mining sector is a little teeny dot. If you have any movement at all, no wonder it's so strong, because if it gets chased by asset managers who want to move a couple percent out of the stock market into the gold and silver mining area, it'll goose that market up sharply. And that, I think, is what you're starting to see now, is very rapid rise. We were $28 on and change on GDX back in late last year, the end of last year. It's traded over 40 today. Okay, in a matter of 3 months or so. Boom. And most of that, a good chunk of that, occurred in the last 4 or 5 weeks. So yes, you're absolutely right. That's one reason we tend to like the miners, because we know fundamentally, though we don't assess them that way, we're technicians, that the mining group is extremely profitable by any normal metric and undervalued.
Now, to reiterate for our viewers, really the price points on silver that you're looking for is 26, 27, right in that range.
Oh, I call it 26.90.
And then for gold, what are some of the price range you're looking for there?
Well, there's one on gold, but it's a price-based one, because frankly, momentum says I'm free to go. I'm going. And that's why we're not trading in the 1700s or the 1800s. We're trading in the middle 1900s right now. Okay. If you do a point and figure chart, and if you know what a point and figure chart is, little X's and O's, okay? Well, if you do a $50 point and figure where every X or O is a $50 uptick or downtick, and you put it on a 3-block reversal, meaning you don't acknowledge a downtick unless there's at least 3 of them. And once you get the downticks, you don't put in the upticks unless there's 3 of them, meaning a $150 move. Okay, well, gold hit 2050, summer 2020, backed off into the below 1700 even. Did a lot of work, came back up at 2050 in March, and fortunately it dropped back to 1900, allowing us to put in a down circle, a down circle, and a down circle, leaving what? 2 columns of X's that both peaked at the same level, 2050. Okay, now if you put upticks again on the board, 1950, 2000, 2050, you're at a triple top. And don't let that word top fool you. You're probably at a triple top breakout, because when you hit 2100, that is a triple top breakout. And that should excite the price guys like crazy. So anybody who's sitting and waiting for gold to amply clear the 2020 high, the year 2020, price was 2070, you hit 2100 and it's just open sky. So we think returning to the top tick one more time is highly likely to be a launch point, meaning a point at which not only gold goes up, but it goes up at a rate that you're not used to seeing. Not 10 or 20 bucks a day, but you might get $1,500 days mixed in there. So watch that. Go back to the high one more time and the lid will come off.
Well, that'll be very exciting. Michael, thank you so much for your time today. The website is olivermsa.com. Did you want to share with us that and any last thoughts you had?
Well, go to the site, olivermsa.com, and you can request some sample reports. Be happy to send them to you. And also on the site, it explains the rationale for our different methodology. We're not orthodox technicians. Price is secondary to us. We do our own unique momentum studies. And the site explains why we do that and how we do that. So anyway, thank you. Thank you for listening. Thank you.
Thank you so much, Michael. God bless.
Thanks a lot. Bye.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty in Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.